The FIX protocol, or Financial Information Exchange Protocol, is the global standard for electronic trading. It connects traders, brokers, and exchanges in real time. Futures markets rely heavily on FIX because of their speed and complexity. When trading a stock, you just need a symbol, a price, and a quantity. But with futures, you must also specify the contract month and year, the exchange, and sometimes the type of strategy. FIX messages carry all of this information in a standardized format. Let's go through an example. A trader wants to buy 10 E-mini S&P 500 futures expiring in December 2025 at a limit price of $4,500. Step 1. The order management system sends a FIX message called a new order signal. This message includes the symbol EAS, the security type set to future, the exchange set to CME, the expiration date December 2025, the order to buy 10 contracts, and the limit price of $4,500. Step 2. The broker receives the order and replies with an execution report. This report acknowledges that the order is live and working in the market. Step 3. When the contracts are filled, the broker sends another execution report. This one confirms that all 10 contracts have been bought at the price of $4,500. Step 4. Finally, a trade capture report is sent. This report provides the final booking details, including the trade ID, the quantity, the price, and the expiration. The back office uses this information for clearing and settlement. This entire lifecycle, from order entry to execution to booking, happens electronically and in real time using the FIX protocol. That's why FIX is the backbone of futures markets worldwide. It ensures traders can connect to exchanges like CME, Eurex, ICE, and SGX with speed, accuracy, and consistency. If you found this explanation helpful, please like the video and subscribe to the channel for more clear and simple explanations of trading and finance.